Today, we're very excited to be speaking with Chris Galipeau, head market strategist for the Franklin Templeton Institute. He generates research and serves as one of the firm's foremost voices on global capital markets, economic trends, and investment strategy. Chris explains why, longer-term, investors should ignore the headlines and tape bombs and focus on the key metric that drives stock prices. We discussed the recent sharp retreat in semiconductors and the Korean market and how you should approach it. Finally, he tells us why he is strongly bullish in 2027. Chris, welcome to the show.
Well, thanks for having me, Ty. I appreciate it.
So much to talk about. And, I guess with this administration, there's never a dull moment. But before we get there, I want to talk about earnings season is coming up on us right now. And actually, I think Pepsi started it and they were a little disappointing. It was kind of a cheap little beat on earnings, and they're down quite a bit the last time I looked. But so what are you've described the upcoming earnings season as the next big catalyst for the tape. And given sort of that dispersion that you mentioned, 200 S&P stocks are actually down for the year. We've still got semiconductors in something of a frenzy, but a little cooler, and credit spreads like very, very tight. Is there a single number or guidance? Is there a fulcrum for you in this earnings season that you're watching?
Well, it's a great question, right? And so if we go back to Q1 on a reported basis, earnings were up roughly 25% year on year, right? So Q1 this year was Q1 last year, which was well ahead of street consensus. It was ahead of our own internal, we don't really have a consensus number, but ahead of our own estimates, beat Wall Street consensus by 100%. So it was a double on a reported basis. And I've been doing this for 35 years as an equity guy. I don't know if I can recall the actual reporting season being 100% better than the consensus. So I think as we go to Q2, and of course, that's why the tape has been so resilient. As we go to Q2, I think we're going to have a semi-similar situation, right? I wouldn't expect plus 25, but consensus, I was just looking at it this morning, is plus 21-ish. And so I think the bar is pretty high here in terms of what stock prices are likely to do in reaction to their numbers. But I think the backdrop is fine. I don't know exactly where it's going to land, but plus 12% revs, operating margin or EBIT margin, somewhere around 14%, earnings are going to be north of 15% for the quarter.
So you're looking for a 15% growth quarter on quarter for Q2.
Yeah.
Now, any harbinger names like, oh, that's a little scary, or anything like early on that you would probably focus on as a signal?
What I love about earnings season is it starts with the big banks every time, right? And so we'll hear from JP Morgan, Bank of America, Citi, so on and so forth, Goldman, Morgan. And the reason I like it is they come on, they talk about how they are viewing the economy, what's really going on with their client base in terms of spending, how is their loan book performing? So that includes everything from credit cards to mortgages to student loans to commercial and industrial loans. So you get a very good look at how people are spending. They'll talk about their customer base's spending patterns quarter on quarter. Q1 was very robust. And to be frank, Q1 of this year was just a repeat of everything they said every single quarter in 2025. Strong consumer, resilient, economy, consumer still spending. I think in Q1, spending in one of the big banks, I think it was Bank of America, was plus 5% year on year. So I think we're going to hear similar things. Now, to the extent that we get some dampening of enthusiasm, that will be the first signal that we need to pay attention, but I don't suspect that that's going to happen. When it comes to technology, of course, the bar is high there. I think people have high expectations. I expect, it's not so much in the report itself. That's rearview mirror, right? So what we really look for is how does the report, but most importantly, the guidance, how does that stack up against our pro forma income statement, our earnings model? Are there any surprises there? Are COGS too high? Is margin under pressure? Are COGS lower? Is margin better? What about top line? How's that impact net income? So on and so forth. So I think tech is going to get all the attention, but the reality is this, that the earnings power in the US, if you break it down by the major indices, if you break it down by the S&P GIC sectors, is about as strong as we've seen in 10 years. It was the case for 25. It looks like it's the case for 26, and it looks like it's the case for 27. So 2-year EPS CAGR is fabulous at the index level, then at the sector level. Should be robust.
No, you said, I love this quote. It's earnings drive stock prices in the long run, not geopolitics. And, we've been taught a lesson in that, over the past few months, most recently the last few days, I suppose, right? You're looking at the EPS estimate for the S&P 500. It's up from 310 to 341 on the back of Q1 beats. Is there any, again, like, where do you think if there's going to be some damage on earnings, is it, because the AI, capital expenditure cycle is maybe slowing just a little bit? Is it, sort of the returns from the One Big Beautiful Bill Act is now finally tapering out? What makes you concerned about earnings? Is it because maybe folks can't, firms can't raise prices even though their costs are going higher? From the earnings picture, what are you thinking?
Yeah. So the estimate's actually gone up in just this week from 341, 342 at the close last night. Now it's 344. So this has been consistent every week throughout this calendar year. The estimate has continued to nudge itself up. Let me be clear. I'm not concerned. I don't have any great concerns. I think, one thing we'll be watching, for instance, from the hyperscalers is we're going to want to hear some sort of measure, some tangible thing to get our arms around in terms of ROI. Now, we started to get that in the first quarter. If you go back and read the transcript or listen to the call from Amazon and Google, that's exactly what they talked about, and they showed us proof. So, those stocks, Mag 7, have vastly underperformed, not just for this year, but for the last 18 months. And we know the concerns, right? We know the concerns. They've eaten up all the free cash flow. Now look at Amazon this week going back to the market with a bond deal to raise more money. SpaceX goes public, then goes and raises more capital. So people are rightfully concerned about that. I think that is everything that's known and knowable is reflected in stock prices. We know that, right? So any indication that the CapEx part might slow a little bit, I don't think we're going to hear that. But that the ROI, the discernible ROI, is starting to show up, that will move those stocks forward. And if you think about where they are here, and we haven't been really super constructive on those names necessarily in the past 18 months, we've liked everything else, but look at it in the last 2 weeks, now you're talking about these stocks trading about a PEG ratio of 1. The PE of the basket is below its 10-year median. Now, that doesn't mean the stocks have to go up, but any incremental good news here, those stocks are going to work. They already have, right? We started to get constructive a couple of weeks ago. They're outperforming the S&P already. That space feels to me like it's bombed out. We'll see if I'm right.
Okay, so I hate putting words in your mouth, but it's fun. A bold call, contrarian buy of the Mag 7 ahead of earnings.
Definitely.
All right, love it.
Yeah.
That's going into the introduction. I have a question about, you talked about retail excess, I should say. And some of the data you point out to, semiconductor options trading at 6 times the historical average, $200 billion in leveraged ETF assets. I mean, I've talked many times about how dangerous those are. And U.S. margin debt up to $1.5 trillion. You see all these and you're really concerned. So how do we think about those in terms of what you're just saying, that earnings are driving prices? You're not worried about earnings, and we'll get a clue from the financials. How should we think about these sort of warning signs that we're seeing in retail versus actually earnings power?
Yeah. So the reason I wrote about that is I'm asked constantly, do you think this is a bubble? Right. So I ran large cap growth money right through 2000, and one guy's opinion to me, this is not an apples to apples comparison, and it's not close, right? Whether you want to look at valuation, whether you want to look at FCF generation, whether you want to look at revenue growth, earnings growth, right? All of those things to me don't point to the same conditions that were present in 2000, with the exception in the last month or so, that semi space started to worry me. And, if you're sitting at home listening, go pull up a 5-year chart of you pick your semi name, Micron, and that is what a parabolic looks like. So I look at those price movements. The fundamentals being what they are, which are excellent, also known and noble, right, at this point. And then you start to see the data around margin debt, which that concerns me a little bit, but there's also a very good correlation with higher margin debt in the bull tape. So, but I thought it was worth pointing out. The levered ETF stuff and the 20 billion in new dollars into levered ETFs, I think last month alone, I could be slightly off on that, caught my attention. The options activity caught my attention. The vol in that space in the last month had my attention. That was, to me anyway, especially as a growth manager, that's a warning sign. Now, very quickly, those names have pulled in, right? So through the close, or I was doing this morning, I guess not the close, but somewhere around 10, 11 o'clock. Micron, for example, 30% off its high. The SOX index about 20% off its high in a week and a half, 2 weeks. So hopefully that gets some of the froth out of those names. Probably not all out, right? But you need the speculative nature of that, like the casino nature of in that space right now, to get unwound. And people need to remember and be reminded of what risk really looks like. It's all great when it's working, and when the music stops, it can be painful, and it can be painful quick, as we just noted with those pullbacks, right? So fundamentals are fine there. The overall picture is fine. And I would just reiterate what I said earlier, that if you look at EPS CAGR for the next 2 years, it's very hard to get negative, right? And the only thing, now this is not a new position for me, we've had that view for the last couple of years. The only thing historically that puts earnings under severe pressure is the Fed tightening too much, keeping rates too high for too long, and breaking something, right? And then you've got the black swan stuff like COVID. So hopefully we don't have a black swan. The Fed is unlikely to do that now. So I don't see anything that can really throw a curveball in earnings. You said earlier, the tape reacts to earnings drive stock prices. That is 100% correct. I don't care about politics, geopolitics, or any of that, right? And it's easy to get caught up in all that noise. Doesn't matter. Doesn't matter over the long term anyway, right?
Yeah. I want to get to the Fed in a second. I do have a question. One of the things that and we talk about froth and excess, and as you all know, a lot of my audience is Korean, and for the first time, I think the last 2 weeks, the first thing I look at when I turn on my my little phone at night is, where's the Kospi?
Yeah.
Has anything gone off the rails? When you have, they. I mean, I look at SK and I look at Samsung, and their forward PE is like 6 or 7. And I'm like, it's cheap. But then you look at the chart and it scares you. The levered ETFs there scare me. Do you think that's the story you just told about a bit of froth coming out that's necessary? Is that applicable to the Korean market? I mean, those two names are 60% of the index, which is shocking.
I totally agree. Absolutely. And if you look at the vol and the Kospi, it's just a replication of the vol and the SOX index here in the U.S. So no question about it. I almost flip my screen here back to Bloomberg just to see how this Hynix ADR thing is going. I haven't been able to really keep track of it today, but I think it's today or maybe after the close. That could be some sort of clearing event. It's supposed to be 5, 6, 7 times over, which those numbers are don't read too much into the numbers because they're not really real. But yes, I agree with you 100%. And that sort of speculation, it's one guy's opinion, that froth, as you say, that needs to come out. And look, I think we made some progress toward that goal here in the last week and a half, 2 weeks. Maybe we have some more to go. And with the the compare and contrast of the multiple versus the chart, okay, remember too that the rule around trading cyclical stocks, and let's be honest here, you're a commodities guy, the bleeding edge of cyclicality in tech space is the semi space. Now, of course, we've got this massive shortage going on. So the 5 times multiple, cool. Let's make sure it's not on peak earnings.
True. Fair enough. Fair enough. I do want to move to the Fed. Well, actually, let's move first before we get to the Fed. You wrote about something that was really, really compelling, and you talked about how the 2-year Treasury yield is 4.16, right? And that's two rate hikes. But the break evens have collapsed. The tips versus the same year bonds have collapsed. So, I mean, they're both the Treasury market. How do you square 2-year yields at 4.16 when the break evens have collapsed? So, are they different people trading different things?
Ty, it's a good question. I don't have the answer to it. I just know that I've watched those for 35 years. And so on one hand, you've got the 2-year, and it could be different people trading different things, I guess. But if you look historically at the yield levels in 2-year yield, U.S. 2-year yields now, and then you map Fed funds over that, what you'll see is that 2-year note yields are historically a very good predictor of Fed policy, what the central bank in the U.S. is likely to do next. So you're right, 50 basis points over the effective funds rate, that says 2 hikes. You go over to break evens, which is, as you pointed out, nominal minus tips, is the bond market's real-time pricing of annualized inflation out 1 year, out 2 year, out 5 year. You pick your tenor. Those have come completely unglued, right? Back to multi-year, well, not multi, but a couple of year lows. So I don't know how to rectify both of those markets. I don't know that I've ever really seen them in this much of a contrast, right? I hope privately that the break-even message is the right message. It's just hard for me to see the U.S. Fed taking action here when we know historically you have a conflict, the supply shock, right? Oil prices go through the roof. You're a seller on that spike every time. That's what I told our clients here when that happened. That was on home run. Now oil's 40% off that high. Break evens have collapsed commensurate with that. I don't know why 2-year yields are so sticky here. They try to give it back a little bit, but they're really not budging. And then the final piece of the puzzle would be you've got 2-year yields, break evens telling completely different stories, and then you got Fed fund futures right in the middle, right? So 2-year yields say 50 basis points hike. I just don't believe that. Break evens say do nothing. Fed fund futures, last I looked this morning, have 1 hike priced in for December. I don't know how to rectify it.
Yeah, I look at the Fed funds futures because it says that's the most convenient thing to me to look at because I don't have a Bloomberg terminal right now. But 80% chance of a hike by December, and some portion of that 80% sees 2 hikes. It's hard to see in my view, it's hard to see the Fed raising rates into a decently recovered jobs market, but not but inflation's reasonably not accelerating, raising rates into that. Not only with Trump probably calling an airstrike on the Fed. How do you see it? Do you see it? I can't seem to see a hike this year.
I'm with you, right? Because so we're watching core PCE. Last trade's I think 3.433. So the target's 2. It's way above. It's been above for 5 years. Some of this is related to the oil price shock, but let's be honest, the U.S. economy is not overheating. They can raise rates all they want. That's going to do nothing to put downward pressure on the price of oil. It's already done that. Gas prices are starting to come down. It just takes a while for higher, petrochemical prices to flow through the system and then clear and reset on lower prices. So I don't think they're going to raise rates. It just doesn't seem logical. But you and I aren't on the Fed either.
Yeah. It just seems that wouldn't be the right lever to push, so to speak. So why don't we just all sit and watch the World Cup? I want to talk about oil a little bit. WTI goes from 67 to 120. You said sell it, which was absolutely the right thing to do. Although I have to say, it's hard to say sell it then, right? And you sold it, you probably took profit at like 105 or something like that. Goes back down to 67. Trump says really nasty things about Iran, and now it's sort of a relaxed 72. But it doesn't look like the second reaction, as in most markets, the second reaction is much less than the first one. Are we being too sanguine here? I mean, is this? supplies are low. Gasoline and heating oil and diesel are relatively high. Are we being is the market being too sanguine here?
I offsetting everything you just said, you could make the case for the amount of oil that's on the water and the movement out of the Middle East that we didn't know about, assuming that what Trump said is correct, that they moved that overnight. And there's a lot now. There's massive supply. Look at the Saudi cut earlier this week, right? Moving the biggest move down in spot price they've ever done. So I don't think so. I think that the price is probably, remember that the best source of information for all of us, I've learned this the hard way. You probably would agree. The best source of information are market prices. It's not economists. It's not what other people say. It's not what the media says. It's what the market you're trading or investing in is actually doing, because someone out there has better information than you do. Someone out there has an information edge, right? And so that's how I think about it anyway, and that's served me well over time. I don't think we're being too sanguine about it. I think the market has headline fatigue, Ty, right? It's got, yeah, I'm sick of it. You're probably sick of it. Your listeners are probably sick of it. And the stock market really and the bond market haven't been reacting to anything that's been going on in the Middle East for months. And so I think that makes sense to me. Now, all the while, under the surface, the real variable that matters, the driver, earnings growth, as we talked about earlier, was spectacular in Q1, and it's not just a U.S. story. It's strong in EM, right? Now, some of that's Korea and Taiwan, of course, but earnings picture looks good. And I think that's the variable we got to focus on and kind of put the blinders on and block out the noise. I know it's easy to say, but it's not. It's hard to do.
Yeah, you're absolutely right. I feel like I always have to click on Truth Social multiple times an hour. Let's see if it actually said something again.
I have my Bloomberg set to alert me with a drum snare roll every time he puts something out, because we have to watch.
Someday when I have a Bloomberg again, I will do it. So, given your relatively sanguine view about earnings, where would oil have to go and stay for you to be a little concerned? And just we'll just talk about WTI. I mean, you can add $5 for Brent. Above what level do you say, you know what, I may have to change my thought on this?
So as this conflict was kind of rolling out in the beginning, I did write about this, and I said, look, I think we need oil, WTI, north of 125, not for 6 days or 6 hours, for 6 months. If that happens, we could have an issue. Now, the flip side of that argument is that's exactly what happened in Ukraine, and there was no issue, right? So, but I think if you keep it elevated there, the real risk in that whole scenario, and I'm not saying we're through that part of the risk, is all the damage that's been done, right? And so with Russia, Ukraine, you had oil well north of 100 for like 6 months. I think you'd have to have something similar to that and the most pain there is not going to be the United States, right? Or the U.S. equity market, probably. It's going to be Europe. It's going to be EM, India, Japan, South Korea, so on and so forth. So let's hope that doesn't happen. That hasn't happened. But I think other things have been going on too to alleviate, like China's demand, as we read about, seems to have come down a lot, and probably that had something, a very, very important impact on oil prices not running away.
Great. Just want to talk a little bit about sort of market breadth. Year to date, the S&P 600 is up like 20%. The mid market 400 is up 13%. The equal weights are actually slightly beating the overall index, like 11 to 10%. I think you made a good point about equal weight. Are at all-time highs. They've done very well. Do you continue to hold that view as we go into the second half of the year, or have the sort of the small and mid guys have had their time in the sun, especially if we think the Mag 7, the hyperscalers are gonna buy right now?
So let me walk you back a little bit. We were finishing 2024, and I noticed small and mid cap stocks starting to act better. To my point of there was no news, there was nothing I could get my arms around, but I could see those stocks acting better on an absolute basis and on a relative basis. And if there's one thing I've learned over time as a PM, it's you need to be aware if something starts to move and you don't understand why, and you're best served to trade in the direction of violence, either up or down, right? So we saw that happen in July, August, September, and small. We then did a lot of research, and we looked historically at the conditions that have always been present for the tape to broaden out. And there were 4 variables that were always in place before, right, so preceding a market broadening. And I did this work on the US, and it's probably true around the world. But here's, in no particular order: GDP accelerating, check. Fed cutting rates, check. Earnings estimates biased up, check. And 4, period of high index concentration, check. So then we went and looked at the earnings estimates and 2-year EPS CAGR on a go-forward basis. At the time, we were looking at 25 and 26. Now it's 26 and 27. The story hasn't changed. So at that point, we rolled into 25. I published that paper in January of 25, and the title of it is Get Ready for a Broader Market. And we thought Mag 7 would give up its dominance. Nothing wrong with the companies, but for the first time in 5 years, you had earnings growth away from those names. And I thought that was going to be a game changer. That's worked. So I'll give you some interesting stats. So from January 1st of 25, in the US now, large cap value and the Russell 2000, leaders in the clubhouse, plus 37%. This is through last Friday's close. The laggard, Russell 1000 growth, plus 21. Mag 7, plus 24. So quietly, and mid caps are in the middle there. Quietly, value and small cap have taken the baton. Started 18 months ago, right? And Mag 7 and large growth have stepped it back. Now all Wall Street wants to talk about, every research note I get from the street every day is, hey, Ty, do you know the stock market's broadening in the US? Got it. You're 18 months too late. So I think the earnings power, though, is still in place for that to continue. And on a year-to-date basis, that's absolutely been the case. I do think, as we've talked about here, I think large cap growth's probably on sale. I think people have been worried for good reason about the ROI and the CapEx spend and chewing up all the free cash flow that no one ever saw coming. I'm not saying I did see that coming on. I think those stocks have been put in the penalty box for too long. They've underperformed for 18 months. And the bad news probably priced in. Famous last words, but that's my call.
It's almost as if, they talk about how clever Goldman is. Goldman was broadening, had the broadening trade on in January, and they're probably taking profit now. So you want to, it sounds like it may be something like that. In terms of, one of the names that the foreign stocks had been doing very well. IXUS, EWY for Korea was doing very well. And it was especially compelling when, the dollar looked like everybody was bearish the dollar. I remember we had a conference and you polled 25 people and everybody's favorite trade was the lower dollar trade. And that was, sometime middle of last year. So 2 questions. What do you think? The dollar has, best it's been doing, dollar index anyway, DXY, the best in year and change. Is it a real breakout? And then the second part of that question is, what do you think of, taking, putting money offshore in, sort of European, non-US indexes, I should say.
Right. So a couple things. We're bullish ROW equities, specifically Japan and emerging markets all in, right? As we discussed earlier, now Taiwan and South Korea are bigger weights than China. And Latin America looks okay too. So believe it or not, we made that call 18 months ago with the broadening call. And we saw the earnings power there. But I agree with you 100% that the consensus has been and still is that the dollar should be weaker. Now, if you pull up Dixie, what you're going to see is it's range bound 96 to 100 for the last 15 months, right? So the consensus has been dead wrong. Broke out 2 weeks ago, traded through 100, right? So technical breakout there. That's probably a pretty good sign. Now it's consolidating a little bit. Honestly, our house call is range bound 96, 100, not going to strengthen a lot, not going to weaken a lot. And you know what? The fundamental pieces in place for equity markets outside of the US, again, we like EM, we like Japan. That's what we've been pounding on, been right, because the earnings picture there looks very good. Now, if Dixie weakens, is that a tailwind? Yes. If it strengthens, is it a headwind? Yes. We never believed we were set up for 2002 to 2007 40% decline in the trade weighted dollar, or any weakness for that matter. And it hasn't materialized. So I think probably now with that breakout, you've got some people saying, okay, we got to cover that and reverse that trade a little bit. But I wouldn't expect much. And I do think on currency anyway. And I do think that you've got the fundamental piece in place on the earnings side. And that's the variable that matters most. And like FX can swing it one way or the other. I remember when I, first became an analyst and I was an industrial analyst, right? So I covered CAT. Does a lot of their business outside of the US, very sensitive to commodities, very, very sensitive to currency. And I talk to the management and I try and figure out what's your FX exposure, how do you hedge it, and finally the company's like, you know what? We're terrible at this. We can't get it right. And as a PM, I couldn't get it right really either, right? So I think I would kind of put that on the back burner and put the earnings piece on the front burner, knowing that that's the main driver.
So you like Japan because they also have good earnings growth, and certainly you're seeing that earnings growth, led by Samsung and SK, just get a little froth, and I think a lot of the froth might be out, with this move down from 9,300 to 7,000, very very quickly. I have a question. I want to see what you think about the job situation in the U.S. We had, sort of a couple of months of really substantial growth and then revisions higher, which we hadn't seen in a while. And this last number, right? It's sort of a disappointment on the headline and revisions lower. Is this, did we just get ahead of ourselves in April and May, and now we're just flying out in June? Or is it a warning of, maybe labor market, weakness later, maybe if not in Q3, maybe in Q4? Any early reads on that?
No real early reads. I'll be honest with you and your listeners. I don't even pay attention. The government data that comes out is, like you say, goes through 3 or 4 different revisions. This one, you had some revision activity. You had the participation rate down, the unemployment rate down, right? And so who the hell knows? But what we do know is we've been operating at roughly full employment here for a number of years. And until and if there's something that comes along, and this again would be the Fed raising rates to thwart aggregate demand, right? Raising rates is a blunt instrument. They're going to raise the cost of money, and so it puts pressure on homeowners and revolving debt and that sort of thing, and business activity, and everything starts to slow, and then consumers pulling their horns on the spending side, and then the economy starts to slow, and maybe you can get yourself into a recession. I wouldn't read anything into that right now. And one of the things that I think will be really interesting to watch is with Warsh now at the Fed. What did he tell us a couple of weeks ago, right? He's established 5 task forces, one of which is focused on how can we collect the data that we use to make policy decisions better? Because if you knew what the system is of sending out things in snail mail and getting 60% response rate, so the N is tiny and it's way lagged. That's why it's always revised. Look, I don't really care about it, and the stock market and the bond market will move way before any economic data tells me there's a problem.
I think it's a great plan. Sort of, five task forces. It smacks a little bit of McKinsey. I'm gonna get these task forces to tell me what I want to hear, and then I'm gonna go ahead and do them. That's what struck me. But I have to say, I was very impressed with him. So far in his new seat. Certainly maybe a different regime, maybe a welcome one. I want to move a little to talk a little bit about bonds. We seem to think that maybe the 2-year is a little out of hand, but 10-year, around 450. Is it a range between 4.25, 4.75, or is there an opportunity in the longer end of the curve to either clip coupons and hope for capital appreciation, or maybe just one of the two?
Yeah, our call for 25 was a coupon clipping sort of environment. And we didn't think rates would do, 10-year yields would do much. We have the same view this year. We moved our range up from, we had it 4.25. We've moved it up 4.25, 4.75, allowing for a little wiggle room here with higher oil prices and maybe some cost push inflation, which we've seen a little bit of. But I don't think that 10-year yields are going north of 5, and I don't think they're going to 3.5. So A big driver of total return, obviously, is duration risk, the sensitivity of the bond price to interest rates. I don't think that's going to be a tailwind. I don't think it's necessarily going to be a headwind. I've told our clients that if yields were to trade north of 475, then I would be okay adding to core fixed income portfolios or getting a little more duration on the books. If we trade to 5, I think you go at it pretty hard, right? You're not asking questions, you're putting the trade on and getting some exposure. But if you take rates and the rate movement out as a driver of TR and spreads are, super tight in IG and high yield, what are you really left with, right? You're left with the coupon. And the only place, at least in the US, where you can find where the coupon is higher than the duration is US high yield paper. So, the coupons there are 6 handle, the duration's 2-3. That's a pretty good trade-off. I know there's high equity correlation there, but we think the risk reward there is good. And people have been gun shy about that space here for the last couple of years. We've been pounding on it pretty good, and it's been a good call. Still like that space a lot. I don't think rates are going to do much, Ty.
Okay, fair enough, fair enough. So sort of oscillating, at the extremes of the range. Maybe if you've bought some, you could take some profit. Makes sense. I like the idea about sort of your coupon is higher. Your coupon is higher than your duration. A good way to think about it. Good way to think about it.
Gives you some safety, right? It gives you some margin of safety. So if you got 6 years of duration and the coupon's 3, and rates go against you by 100 basis points, right? You just lost 6% with the coupon not making up for what you just lost in the rise in rates. At least you can get some of that in height.
Right, that makes a lot of sense. I want to talk about some of the, some of the, sort of the side markets or crypto has had an absolutely rotten time. For any sort of any number of reasons. I wonder, with the fact that Strategy is now selling some Bitcoin, to pay for their preferreds and costs and try to do something of a buyback. Thoughts on crypto? Are we, at a sentiment bottom and there is some value in it, or is just a sector that's just out of favor, and until it comes back in favor, maybe you're probably better served elsewhere.
So again, speaking for myself and not the firm. So we've done a lot of work on Bitcoin specifically, and the role that could play in a multi-asset portfolio, right? What does it do to the efficient frontier? Can it improve the Sharpe ratio and that sort of thing? And what we found in the research is that it does. And so if you have a little piece of the portfolio there, 3-5%, nothing crazy, then it's accretive to the portfolio through risk adjusted lens. So that's the first thing, and we believe that because we have the data to support that. Now, stepping away from that, I'm hard pressed as an equity guy to understand what Bitcoin actually is. So I don't believe it's a store of value. I don't believe it's an inflation hedge. I don't believe it's digital gold. I don't believe any of that, and it's proven that. You know what I think it is, Ty? It's a risk asset that can be traded. And I really believe that that's what it is. Maybe it's going to evolve and it's going to become a legit currency and that sort of thing. But, stronger dollar doesn't help it for sure. It's tough. It's a tough space for me personally. I'm probably the only one that thinks this. I think it's a tough space to get right. And it's seemingly, I'm sure there's a lot of leverage in there. It's momentum-based trade probably for the most part because the actual use cases, at least to me, are very fuzzy. So that's tough spot. I would say if you're going to trade it like anything else, stop loss, good till canceled.
It's one of the, you're right, absolutely right. It does trade like a risk asset, except that recently it's participating more on the downside than the upside. It seems to try to base a little bit, but my view on it is, I think I have like 3% of my net worth in it, and if it goes to zero, it's not going to hurt me. Yeah. And you're just hoping for like some right tail that we can't see right now.
And you might be right, but I think in the immediate term, if it can hold 60,000, it's right. That's trying to bang along that bottom there, and we'll see what happens.
I do ask about gold. Gold was the favorite trade of favorite trades. People were breathlessly talking about 8,000, 8,500. How fast can I raise my my target? And all of a sudden, then I think it was January 30th comes along, and there's a big washout, and then all of a sudden you have war. That's not working. And inflation, and that's also not working. So, is it like perhaps crypto? Is it a sector that was deeply in favored and beloved, and now out of favor, with the exception of perhaps the central banks who seem to be continually accumulating?
Yeah, I, I I think of gold maybe not exactly the way I think of Bitcoin. It's a much longer history with gold, and you can see that it actually has some of the properties of storage of value and a hedge against fiat currencies and maybe weak currencies and that sort of thing. It's interesting that you asked that. So I've been doing this for 35 years, and I've been in the strategist role for the last 8 or 10. The prior 25 was running money. In my career, I've never been asked more about gold and silver than I was in the fourth quarter of last year and into Q1 of this year. You're smiling because you know exactly why they're asking me, right? So they're chasing performance, and I could pull it up and find it here. And if you want me to, it'll take me some time, but I can find it. I thought the same thing about gold that I thought about semis a month ago, and I thought, okay, this thing now is legit parabolic, legit. And that to me, right, the spike always follows the shaft. That to me is a warning sign. And you've got crowded money in there. And I could tell by the volume of questions I was getting that there was speculation there. I wrote about this, I could find it, but I said, look, this to me is getting a little out of hand here, a little speculative. I don't think the bubble's in AI. I think the bubble right now is in gold and silver. Sell it all. That's dated and time-stamped in writing. Nailed it. And the odd thing about it is, about 2 weeks ago or 3 weeks ago, I revisited it. I like to hold myself accountable for the calls. I believe that that's, it's my job to make it and give good advice as best I can, but to be held accountable when I'm right and when I'm wrong. I went back and revisited it. And I think the decline from the call was, I don't know, 35, 40% or something. It was more in silver. And I thought, I wonder if it's time to go back here. But what was interesting is, how many questions do you think we're getting about gold now? Zero.
I think you should have in your written pieces, you should have the occasional, how many questions did I get asked about this and compare? And that should be the indicator. It would be the opposite of the economist indicator, because they always seem to get it. They pay the highs and hit the lows enough the whole time. I think they actually studied how often they were wrong recently, but they're paywalled, so I didn't get to read that article.
I saw it, but in my career, I laugh that you said that. Because you're 100% right. You can make the same case for Barron's, right? When it's on the cover, it's wrong way. Take the opposite side of the trade. Yeah. So.
My final question. I thank all the time you've spent with me, and this is taking out really longer term, into 2027. I interviewed a little while back a really smart, successful fellow, and he pointed out a statistic that I was not aware of, and he said since 1930 or so the last 100 years, with a couple of exceptions, the third year of a presidential term is generally extremely good years, the best year of the term. Now, that would seem to augur very well for 2027. What do you think of that? Is that a statistical anomaly, or is there, something really behind it that, in midterms, usually the president's party loses power and then you have paralysis, and, Wall Street loves paralysis?
We've actually done the work on it, and I have the data right in front of me. And whoever you were speaking to is right. So the second year of the presidential cycle, called the midterm year, that's where we are now, is historically the most volatile and has the lowest annualized return in the S&P. The worst quarter is actually Q2, which we're through at this point. But I'm just going to look to the side here. I'm going to read you some of the stats. This goes back to 1950. This is our data set. Presidential in the midterm year, the average drawdown in the S&P is somewhere around 18%. The max is about 38. The min is about 2 or 3. The average is 18. The median is probably maybe a little lower, 15, 16. That's this year. And I think that's pretty well known. I think people know that. But what people don't know is the third year is the best year. Again, data set, S&P 500 back to 1950. Average return for the S&P from the midterm low, from the trough low. Now we're doing this ex post, right? We're doing it ex post. So from that low forward into 27, the average S&P rally is about 30%, and the hit rate of positive returns is 100%.
So I guess the low this year is likely to be, what was it? Was it? Gosh, I can't remember off the top of my head.
Yeah, in March, and so we've already rallied 20% off that,
Yeah.
right? It will not surprise me if we get more chop here through the summertime as we get to November. I don't know that there are going to be any great surprises, but history tells us to be on guard, right? And history also tells us that if we get any meaningful weakness, I don't mean 2%, 5%, I mean 10, 15%, we start to say, oh boy, I wonder what's going on here. History tells you to buy that. And that is also our message.
Okay, that's great. Well, Chris, thank you so much for spending so much time with us, for your insights. We look forward to having you on the show again.
I appreciate you having me, Ty. Good luck, everybody. Remember, stop loss goods will cancel. The market knows more than you do.